Top stories live from the Sky News City studio. The water regulator moves to ease fears of a collapse of Thames Water, saying the company has strong liquidity. A tough outlook for investors as monetary policy is predicted to be tight around the world during the second half of the year. A vote of confidence for the London stock market. A climate tech company, Ceres, is listing on its main market. Plus, why artificial intelligence could be a job generator in the advertising sector. Good morning, this is Ian King live, an hour of business and economic news from the heart of the city. The water regulator Ofwat has moved to ease fears over the financial future of Thames Water. In a statement released during the last hour or so, it acknowledged problems at the company, but it reassured customers that there were no liquidity issues. An Ofwat spokesperson said, "We have been clear that Thames Water has significant issues to address. Their environmental record and leakage performance, for example, are poor. Alongside the turnaround of their operational performance, they need to improve their financial resilience too. But that is all in the context of a company that has strong liquidity. It recently received an additional £500 million from shareholders and has £4.4 billion worth of cash and committed funding." Well, our correspondent Ashna Arenag joins me now. Ashna, I mean, this is really a bit of a note of calm, I think, from Ofwat. I mean, some of the reporting around this story has been absolutely hysterical.
It really has. It's all over most of the front pages today, Ian, as you will know. It's also been heavily in the media, I suppose, over the last 24, 48 hours. It's interesting, though, that they do stand by that statement, strong liquidity, but in the same breath, they are saying that the company does need to improve its operational performance and that there are some serious questions to be asked about its financial resilience. Of course, some people might say, why are we focusing so heavily on Thames Water when other water companies we know are also in some financial difficulties? But they do have a huge debt on their shoulders. It's something like between 10 to 14 billion pounds, a debt that's accumulated over a number of years and due to a number of reasons. I think ever since that the CEO of the company, Sarah Bentley, resigned on Tuesday, given that we had an urgent question on it in the Commons yesterday, really attention is fully ramping up now on what is to come next. This morning, the government have come out in doing their media rounds and have tried to ease those fears, really, by saying that they do have contingency plans in place that are ready to be deployed. And that would be the first time that a so-called special administration procedure, one that we saw the government bring in for the energy company Bulb in 2020, would be brought in for a water company. So concerns there, but in the short term to medium term, it doesn't appear to be likely that we're going to need to lean on such an administrative process. It is going to be more so the shareholders and internal resources that are going to be looked to first to try and pull them out of these financial straits.
Now, in the last few minutes, Ashna, the Times is reporting on its online editions that Sir Adrian Montague, City Grandee, who I've known for a number of years, is going to be the new chairman of Thames Water.
Yeah, that's right. Someone that brings an incredible amount of experience, Ian, as you will know. Previously, the chairman of the FTSE 100 insurance giant, Aviva. Somebody who is likely to take over, as the Times is reporting, from the current chairman at Thames Water, Ian Merchant, who's only been there for a year. But look, he's got a huge amount to try and contend with. It's worth saying that a lot of these financial burdens stem from an awful amount of sewage pollution and leakage that Thames Water has been responsible for. Last year, a report by the Environment Agency found that the company were responsible for a fifth of sewage-related incidents and pollution-related incidents over the last year in the UK. And also there have been accusations that the company has prioritised paying dividends and returns to its shareholders rather than making that investment. It's believed that they're going to turn to the shareholders for an initial £1 billion to try and rescue them at the moment. But the worry is that the taxpayer could be forced to pay up either by dipping into public funds or with bills having to rise.
Thanks, Ashna. Well, we're just going to break away from the business news momentarily now to take you to the Court of Appeal, which is ruling on an appeal against a High Court ruling from last December on the government's Rwanda policy. That ruling found it was lawful to send some asylum seekers to Rwanda to have their claims processed rather than dealing with their applications for sanctuary in the UK.
In the case of the individual claimants, the decisions to remove them were quashed on the basis of procedural unfairness in their particular cases. But the court dismissed the generic challenges to the Rwanda policy. The appeals to this court are against the High Court's decision on the generic challenges. The government has not appealed against the quashing of the decisions in the appellant's individual cases and has not yet made any fresh decisions in those or other cases pending the outcome of the appeals. The appeals were argued before us over 4 days between the 24th and the 27th of April 2023. The grounds were numerous and included other legal issues besides the question whether Rwanda was a safe third country in the sense we have described. The court had to consider a great deal of detailed evidence as well as other materials. The United Nations High Commissioner for Refugees was permitted to make submissions as an interested party, and evidence filed on behalf of the UNHCR formed the foundation of much of the appellant's case. By a majority, this court allows the appeal on the issue of whether Rwanda is a safe third country. It unanimously dismisses the other grounds. There is a subsidiary question about whether there are substantial grounds for believing that persons sent to Rwanda will face a real risk of treatment contrary to Article 3 in Rwanda itself. Although we do not all take the same view on that subsidiary question, the decision of the High Court is undisturbed on that point. I will now give a very brief summary of the Court of Appeal's reasons. To understand the detail, it is necessary to read the judgments, which will be made available in court and online as soon as I have delivered this summary. The decision of the majority, the Master of the Rolls, Sir Geoffrey Voss, and Lord Justice Underhill, the Vice President of the Court of Appeal's Civil Division, is that the deficiencies in the asylum system in Rwanda are such that there are substantial grounds for believing that there is a real risk that persons sent to Rwanda will be returned to their home countries where they faced persecution or other inhumane treatment when in fact they have a good claim for asylum. In that sense, Rwanda is not a safe third country. That conclusion is founded on the evidence which was before the High Court that Rwanda's system for deciding asylum claims was, in the period up to the conclusion of the Rwanda agreement, inadequate. The court is unanimous in accepting that the assurances given by the Rwandan government were made in good faith and were intended to address any defects in the asylum process. However, the majority believes that the evidence does not establish that the necessary changes had by then been reliably effected, or would have been at the time of the proposed removals. In consequence, sending anyone to Rwanda would constitute a breach of Article 3 of the European Convention on Human Rights, which Parliament has required the government to comply with. In agreement with the High Court, I have reached the opposite conclusion. I agree that the procedures put in place under the Rwandan agreement and the assurances given by the Rwandan government are sufficient to ensure that there is no real risk that asylum seekers relocated under the Rwandan policy will be wrongly returned to countries where they face persecution or other inhumane treatment. I have concluded that the chances of failed asylum seekers being returned to their countries of origin are in any event low, not least because Rwanda has no agreements in place with any of the countries in question. In addition, extensive monitoring arrangements, formal and informal, of all those sent to Rwanda and of their asylum claims once there provide powerful protection. I take the view that the arrangements put in place provide sufficient safeguards in a context where both governments will be determined to make the agreement work and be seen to do so. As for the grounds on which the appellants have been unsuccessful, I can summarise our reasoning as follows. 1. The effect of the Refugee Convention. Article 31 of the Refugee Convention does not, in principle, prevent the United Kingdom from removing asylum seekers to a safe third country. 2. Retained EU law. EU law only permits asylum seekers to be removed to a safe third country if they have some connection to that country. None of the appellants has any connection to Rwanda. However, the court holds that that requirement has ceased to be part of United Kingdom law as a result of the provisions of the Immigration and Social Security Cooperation EU Withdrawal Act 2020, which is part of the legislation dealing with the consequences of the UK's withdrawal from the European Union. 3. Designation as a safe third country. Schedule 3 to the Asylum and Immigration Treatment of Claimants Act 2004 allows the government, as long as it obtains parliamentary approval, to designate particular countries as safe. The government did not in these cases make use of those procedures. Instead, it proceeded by giving guidance to caseworkers for application in individual decision. The court holds that it was not unlawful for it to proceed in that way. 4. Data protection. Decisions to remove individuals to Rwanda are not themselves invalidated by any breaches of the data protection legislation which it is alleged would or might occur in the course or in consequence of their removal. 5. Fairness of procedures. Asylum Aid submitted that the procedures by which the government decided whether to relocate individual asylum seekers to Rwanda were inherently unfair, in particular because of the short timetable applying to representations seeking to resist removal. The court rejects that submission, but it holds that some aspects of the High Court's reasoning cannot be supported, and that the government needs to give guidance to caseworkers emphasising the importance of flexibility in granting extensions to the time limits where fairness requires. The result is that the High Court's decision that Rwanda was a safe third country is reversed, and that unless and until the deficiencies in its asylum processes are corrected, removal of asylum seekers to Rwanda will be unlawful. Finally, I should make clear that our decision implies no view whatever about the political merits or otherwise of the Rwanda policy. Those are entirely a matter for the government, on which the court has nothing to say. Our concern is only whether the policy complies with the law as laid down by Parliament. A deliberately tight timetable has been set for consequential orders and directions, partly so that any application for permission to appeal can be decided promptly. The court hopes and expects that it will be able to deal with all consequential matters on the papers. For the avoidance of doubt, our judgments are published with immediate effect, albeit on a subject to editorial corrections basis, in accordance with Direction 1, which I shall shortly mention. If any corrections are necessary, a revised version will in due course be sent to the parties and published on the Judiciary website and on the National Archives website. We will give the following directions for the steps that the parties need to take consequential on our decision. We direct that by 4 p.m. on Thursday the 6th of July 2023, 1. The parties file with the court lists of suggestions for correction of typographical or other minor errors in the judgments now handed down. 2. The parties file with the court draft orders in each of the appeals, so far as possible in agreed terms, giving effect to the terms of our judgments and covering all consequential matters such as costs and permission to appeal to the Supreme Court. 3. Insofar as the terms of the orders cannot be agreed, short written submissions from the parties on the disputed items can be filed. In the case of any application for permission to appeal to the Supreme Court, submissions are required only from the applicant. Submissions from the respondent will be required only if the court asks for them. That timetable is deliberately tight partly
So the Court of Appeal there ruling that the government's deportation policy to Rwanda is unlawful. The Court of Appeal ruling that there are deficiencies in the asylum seeker in Rwanda such that there are substantial grounds for believing there is a real risk that people sent to Rwanda will be returned to their home countries where they may face persecution. So a victory for asylum seekers and the campaigners who are supporting them, a defeat for the government. The government is now likely to appeal to the Supreme Court. We'll have reaction to that throughout the morning here on Sky News. And our monetary policy is likely to remain tight around the world during the second half of the year, which is not a friendly backdrop for investors. That's the main prediction from BlackRock as it assesses the state of global markets and economies at the half-year stage. The world's biggest asset manager does, though, see opportunities being created by structural changes, such as the rise in artificial intelligence, that it expects to create big shifts in profitability across economies and sectors. Joining me now is Wei Li, Global Chief Investment Strategist at BlackRock. Wei, good to see you this morning. The prognosis for central banks has really shifted during the last 6 months. I mean, there were even, if we'd been sat here at the beginning of the year, there were some people who even thought the US might be cutting interest rates at the start of the year.
That's right. I remember that conversation. So back then, we were quite contrarian in saying that central banks and the Fed would not be able to cut rate in the face of persistent inflation. But markets were pricing 3-4 rate cuts by the year end. But fast forward to where we are now, markets are pricing out rate cuts for this year. So it's becoming a bit more of a mainstream narrative that actually growth is slowing down, maybe heading into recession. And at the same time, in the face of recession, central banks cannot come to the rescue as readily as they were before doing that.
How do you tally that, if you like, with the performance that we've seen from some equity markets of late?
Well, so far this year, if you look at U.S. equity markets, the headline performance has been very, very impressive. But if we look under the hood, it's been a very concentrated and thematic story. So the gap between S&P 500 and S&P equal weighted is huge, really speaking to the fact that the broader equity market is starting to register growth slowdown, but artificial intelligence as a mega force is really propping up market, right? And this is also why, in light of the very concentrated performance that we have seen in U.S. equity market this year, we're rolling out the new playbook that looks at first layer, which is macro-based asset allocation. And here we acknowledge that macro environment may not always be our friend, given recession foretold and central banks not being able to come to the rescue of the economy. But layer two is where we want to go granular, so highlighting some sector relative value ideas like liking autos because it's already pricing in recession, and also liking healthcare because of the quality tilt, but at the expense of maybe U.S. financials because of the credit tightening environment still yet to hit the sector performance. So focusing on relative value in that second layer on the fixed income side, really highlighting, for example, inflation-linked bonds. We like U.S. inflation-linked bonds over European inflation-linked bonds. But that third layer, mega force, is really important because so far that's what's been lifting markets, right? So we're saying mega forces, they matter not only over the longer term, but they matter right here, right now. So identifying mega forces with catalysts and incorporating that into portfolio construction is our new playbook.
And another one of these mega forces is the aging population in developed market economies around the world.
Absolutely. So aging population, labor shortage is indeed why we are in this world shaped by supply. So if we think about aging population and what that means for wage pressure, we see here in the UK, core inflation is increasing because of persistent wage pressure. And then on top of that, the transition to net zero, on top of that, geopolitical fragmentation. These are the reasons why we're in a structurally higher inflation inflation environment compared to the Great Moderation and also compared to pre-pandemic. And this is also why central bank policies are evolving. So back then, the broadly disinflationary environment were keeping central bank policy somewhat easy, and they were able to cut rates when economies slow down. But right now, as Sintra this week also have shown to us that central banks are forced to hold policy tight because of the broadly inflationary pressure coming from labor shortage, coming from geopolitical fragmentation, coming from all of those structural changes that ultimately means that there is that bias that ultimately restricts the hands of central banks in the face of growth slowdown, which is why we need to think a lot more granular and also a lot more nimble when it comes to asset allocation in order to supplement what we can expect from a broad building block asset allocation.
OK, Wade, we've got to leave it there, I'm afraid. Always good to see you on the programme, and especially great for you today because you've just flown in from the US to talk to us. So thank you very much indeed.
Thanks for having me.
A bit of breaking news to bring you. The French prosecutor has just announced that the police officer who fatally shot a teenager in a Paris suburb has been placed under formal investigation for voluntary suicide. More on that homicide. More on that throughout the morning as we get it here on Sky News. Some other business news stories for you now. The Bank of England said this morning it would open a consultation on proposed reforms on how the insurance sector is regulated. The government is looking to reform the so-called Solvency II rules, which govern how much capital insurers need to carry on their balance sheets. It hopes the measures could release up to £100 billion that could be invested in the wider economy. The Prudential Regulation Authority, which is an arm of the Bank of England, said the consultation had the aim of cutting bureaucracy, facilitating competition and supporting growth and competitiveness without lowering prudential standards or weakening policyholder protection. The discount retailer B&M said this morning that it continues to enjoy trading momentum in the face of the cost of living crisis. B&M, which trades from more than 700 stores in the UK and which also owns the Heron Foods frozen food chain, said that group sales during the 13 weeks to last Saturday came in at £1.32 billion. That was up 13.5% on the same period last year, with growth strongest in its French business. Alex Russo, the chief executive, said that both grocery and general merchandise categories have performed very well. The insurer Direct Line insisted this morning that it does not expect a review of motor claims it's been ordered to carry out will have a material impact on its 2023 financial results. Direct Line has been ordered by the Financial Conduct Authority to carry out a review of total losses where vehicles had been written off after it admitted it had underpaid some car and van insurance customers. The review covers the period from September 2017 to the middle of August last year. The company said today the potential payments it would be making as a result of the review were provided for in its 2022 financial year-end claims reserves. The French mining group Imerys is forming a joint venture with British Lithium to accelerate development of the UK's largest lithium deposit. The pair said that should their plans come to fruition, Cornwall would become the leading lithium hub in the UK, targeting annual production of 20,000 tonnes of lithium carbonate equivalent. That would be enough to equip 500,000 electric cars per year by the end of the decade. Imerys currently has more than 1,100 UK employees, of which 830 are working in Cornwall, including 5 open-pit mine sites in Cornwall and in Devon, just across the county line. Still to come here on Ian King Live. We're going to have a look at how global markets are doing this Thursday morning. Stay with us.
There is a lot of gas being fired all around us. शांति से इनको समझाओ वरना ये हम लोग It is an absolute carnival kind of atmosphere out here for Prime Minister Modi's decisive victory. These students are defying the prohibitory orders, and now they're going to be arrested. We aim to be the best and most trusted place for news. The roads have been inundated. The only way out is to get people by boat. What is feared that over 200 people might have died because of these landslides. This on any given day would have been bustling with people, but today it's absolutely deserted. This is one of the most sensitive areas of northeast Delhi where there's been clashes. I'm Neville Lazarus and I'm Sky's reporter based in Delhi.
Well, stocks in the Asia-Pacific region had a largely negative session overnight amid ongoing concerns over the path of US interest rates and rates elsewhere around the world. Holidays in India, Singapore and Malaysia also meant that trading volumes are slightly lower than normal. Well, in Europe, stocks have been creeping higher this morning. Only the DAX in Germany is in negative territory, and actually looking at that, it's more or less unchanged right now. Talking points in continental Europe this morning include H&M, the world's second biggest fashion retailer. Its shares are ahead by more than 10.5% in Stockholm. That's after it reported better than expected quarterly profits this morning. Well, here in London, the FTSE 100 is off 0.25% right now in a broad-based sell-off. As ever at this time of year on a Thursday, a number of stocks have gone ex-dividend. In other words, they're trading for the first time without the rights. So the latest payout and the batch this morning includes B&M, which I mentioned earlier, and Burberry. Those stocks both in negative territory as a result of that. Not too many gainers to mention, but Barclays is ahead by 1% or so. That's on supportive broker comment. Outside the FTSE 100, the business services group Serco. Look at that. The share's up more than 12.75% right now. That's after it raised its full year sales and profits outlook. Another gainer in the mid 250 to mention today is Morgan Sindall. The construction specialist is ahead by 2.75%. And that's on news that its results for the year are going to be better than expected. On the foreign exchange markets, well, the main talking point this morning is the Swedish krona. It hit an all-time low against the euro earlier this week, but it's rallied this morning after the Riksbank, its central bank, raised interest rates from 3.5% to 3.75%. Meanwhile, sterling more or less unchanged right now against either the dollar or the euro. The oil price staged a late rally yesterday. It's given up a little bit of those gains this morning. A barrel of Brent crude will currently set you back $73.94 a barrel. That's actually more or less unchanged right now. Well, joining me in the studio is Anna Stupnitska, global macroeconomist at Fidelity International. Anna, great to see you this morning. Obviously, interest rates are the hot topic everywhere, and the Riksbank in Sweden, the latest to move today.
That's right. This is all part of that global race to tame inflation. All the major central banks are hiking. As you said, smaller central banks are worried about currency weakness. So we had the Swedish krona really weak. We have the BOJ also worrying about the weakness of the yen. Those who are lagging behind, who are behind the Fed, the ECB, the BOE, are worried about that currency weakness, and they continue hiking given persistent inflation.
Yeah, it's really interesting, isn't it? I mean, we talk about the sort of velocity at which the Bank of England and the Fed have been raising rates, but it's not so long ago that the Riksbank were employing negative interest rates in Sweden.
Well, the inflation environment has changed so much. They also have persistent inflation, also quite high on the core, and they have to keep hiking, but also keeping pace with the ECB, given the currency weakness.
Yeah, and they've also had quite a frothy property market in Sweden as well, haven't they? Presumably that is going to come off the boil now.
Yeah, I mean, obviously the property market can also be managed with macroprudential measures, but of course that's been one of the hottest spots in the global housing market overall. So all these countries, as interest rate rise, we will start seeing those vulnerabilities resurfacing.
Yeah, now it's a busy day really on the macro front, because we've heard today from both Jay Powell from the Federal Reserve, Andrew Bailey from the Bank of England as well today.
Yeah, we heard from them also yesterday. Of course, we had the highly anticipated central banking panel at Sintra, and it's all in line with the recent messaging. They're very hawkish. They're preparing the markets for further hikes. They still think that there will be no recession. They think they can hike more and avoid recession and tame inflation, but we actually don't agree. We think recession is coming.
And what's the timing on that? You're talking about the US and the UK here.
Yeah, and Europe as well, for that matter, given these high interest rates. The timing has been really difficult to predict. We think perhaps the end of the year or as we go into 2024, but rates are very restrictive. They're in a very restrictive territory already, and they're going to get more restrictive. And this transmission is in the credit channel already. We are seeing those credit numbers really weak now, and that will start hitting the real economy.
All right, Anna, Freddie, we've got to leave it there. Good to see you today. Thank you.
Thank you.
Still to come here on Ian King Live, a vote of confidence for the London Stock Exchange as the green energy business Ceres moves its premium segment. I'll be talking next to the Chief Executive. Don't go away. Welcome back. Now, a number of businesses in recent months have snubbed London to list in New York instead, but today brought a vote of confidence with the green energy technology business Ceres Power moving up from the AIM market, where it's been listed for the last 19 years, to London Stock Exchange's main list. That puts it in line for admission to the FTSE 250 later this year, where it would be just the 12th tech company. Joining me now, I'm pleased to say, is the Chief Executive of Ceres Power, Phil Caldwell. Phil, good to see you this morning. What's behind this decision?
Well, look, we're world leaders in hydrogen and fuel cell technologies, and they're essential to hit net zero, so they're in high demand. We've grown substantially. You know, when I took it on, it was 50 people, 50 million. Now we're 600 million market cap, 600 people in the UK, and it's a logical step for us. And we're quite unusual as a technology business in the UK, that we operate globally through licensing this technology to big names like Bosch, Doosan, and Shell. And for us, it's a natural step in our growth to move from that AIM market, where we've been very successful the past 19 years, as you said, up to the main market.
You weren't tempted to go to the US? I mean, you might have got a higher valuation over there.
Look, there's a lot of talk about the allure of the US. We're a very proud British business. I personally raised 250 million in London in the AIM market. We've built a really strong London institutional investor base, and we've got a UK board. We've got very high governance here as well. So I think for the next stage, we want to be from a billion to multi-billion company, move up to FTSE 250 and grow beyond that, really. So London's the right place. I think the allure of the US is if you move there, I think there's a danger that you're one of many, whereas the problem we've got in the UK is there's not enough tech stocks like Ceres. As you said, we'd be 1 of 12 if we get into the FTSE 250. We've got to change that, and I think companies like Ceres are really good for the UK.
Yeah, it's interesting. I mean, of course, moving off AIM means that none of your retail investors will be exempt from inheritance tax with your shares now. Is that a problem?
No, I don't think so, because we've flagged this for quite some time. And also, with indexation, we then inherit new shareholders as well. Look, I think it's just a natural part of growing the company.
Yeah, and it will make it, I mean, if you're in the 250, it will make it much easier for you to raise capital in future, I guess.
Yeah, look, I think we've always been able to raise capital here in London, but I think the big allure for us of the main market is we can attract more international capital, and as we operate globally, more US capital, more European capital, London can do that for us without having to change the listing.
So tell me about how the business is trading right now. What are the things on your mind?
Look, I think what's on my mind is growth. We're unusual in that we're a high-growth company. What we're seeing globally is huge demand for this technology. Particularly, we've seen big the Inflation Reduction Act in the US, $270 billion there. We've seen big policy decisions in Europe. Japan last week said they're going to put $100 billion into hydrogen. So for us, there's a $20 trillion market opportunity for hydrogen. And because of the way we operate, we can scale the business simultaneously from the UK into the Korean market, the European market, the US market. So for us, it's all about growth.
As you say, though, countries like the US and Japan are putting vast amounts of money into this and making it available for businesses like yours. Where does the UK stand in comparison?
I think the UK is in danger of falling behind, honestly. But I think the beauty about our business model as a technology business, what we're really good at in the UK is technology. What we're less good at is actually building these world-class companies. The model we've taken is ARM. We want to be an arm of clean energy, and the way we do that is through these global partnerships. So in some ways, what's happening globally is good news for us, because we can still grow the company in the UK, but very much with a global footprint.
And briefly, Phil, you're obviously partnering with Bosch in China there. Is the UK government at all sniffy about you doing that or twitchy about that?
No, I think the UK is still very much open for business. And I think that, look, if we're going to hit net zero, we need to decarbonise not just the UK, but everywhere. And that means we're going to have to invest in these kind of technologies. And for us, that's a huge market opportunity.
All right, got to leave it there, I'm afraid. Great to see you this morning. Thank you.
Thanks, Ian.
Time for a look now at this morning's business pages, and the Financial Times splashes its print edition with news that ministers have discussed a temporary nationalisation of Thames Water. The paper's influential Lex column says that the previous owner, Macquarie, which helped grow Thames Water's debt pile, deserves blame for its current problems. The FT also reports on its front page that profits at the Crown Estate, which owns the seabed surrounding Britain up to 12 nautical miles, rose by 42% last year, largely on the back of option fee income from 6 offshore wind farm licences. Well, the Times leads its business pages with Thames Water, but it also reports that 10 of the biggest UK pension schemes have criticised proposals from the Financial Conduct Authority aimed at making the UK a more attractive destination for stock market listings. Meanwhile, the Daily Telegraph leads its business pages with a report that banks have warned that they will be forced to raise mortgage costs for millions of borrowers if Jeremy Hunt orders them to pay higher savings rates. The Telegraph also reports on a crisis at the Royal Institution of Chartered Surveyors after its Standards Board quit en masse following a row with management. Meanwhile, the Wall Street Journal splashes its print edition with an extraordinary story that the mercenary leader Yevgeny Prigozhin planned to capture Russia's military leadership as part of last weekend's mutiny. It says he accelerated his plans after the country's domestic intelligence agency became aware of the plot. Well, speaking of the Wall Street Journal, joining me today is Joe Sternberg from that august publication. Joe, good to see you again this morning. Thames Water's everywhere. We've got to start with that, really. What do you make of this?
Well, I think that what's interesting about this story is actually, I think that this is a continuation of what we saw with UK pension funds and, the whole LDI gilt crisis in the autumn. I mean, the big story here, partly it's related to the amount of debt that Thames Water and other utilities have taken on over the past 15 years. But the bigger point is the fragility of the UK economy as interest rates are rising. So I think from that perspective, don't view this story in isolation. Understand that this is only the next domino to fall, and we might even expect that there will be more down the road.
Yeah, it's an interesting point you make there. I mean, talking of interest rates, all because of higher inflation, there have been some interesting comments from the likes of Andrew Bailey and his predecessor at the Bank of England, Mark Carney, on why the bank didn't get to grips with inflation earlier. What are your thoughts there?
Yeah, I mean, this argument between Mr. Carney and Mr. Bailey is basically about whether you think it was Brexit that accounts for rising inflation or whether it was, the effects of the Ukraine war and the pandemic. I think they are actually arguing about how much they both agree with each other that they think the Bank of England itself was not responsible. So I think that what's disappointing about this discussion is that there still doesn't seem to be a lot of introspection at the bank about the role that the policies that these leaders implemented over the past 10 years or so might have caused, how that might have contributed to the inflation we've seen today.
Do you detect much of that introspection elsewhere around the world from other central bankers?
No, I mean, at least the Bank of England is in good company in not looking too deeply inward. But I think that should be alarming to a lot of people, because if we don't have that kind of discussion about how these policies have contributed to the current inflation, if we're going to continue blaming only external factors like the Ukraine war, the pandemic, Brexit in the UK, we're missing a real opportunity to avoid running into this kind of problem in the future.
Absolutely. Now, another story that you've picked up on is the one that I mentioned just now on the front of the Times this morning. A lot of angst among pension funds about these listing changes.
Yeah, and I think this speaks into what your previous guest was talking about how do you create a capital market in the United Kingdom that can make sure that entrepreneurial companies, especially tech companies, can get the capital that they need to invest and grow their businesses. And I think that what we're seeing is that this is going to require not just regulatory changes, but maybe changes on the mindset of some of the institutional investors in the UK who are going to have to understand that that kind of financial market that can serve that function is a bit different from the kind of financial market the UK has had up to now.
Joe, got to leave it there, I'm afraid. Always good to talk to you. Thanks for joining me today.
Thanks very much.
Now, even though it's in a relatively early stage of development, there can't be many areas of business that have not been affected already by the rapid rise of artificial intelligence. Well, despite some dire warnings for the future of mankind, many industry leaders say it could and should be a boon for their business. Joining me now is Michael Sugden. He's Chief Executive at VCCP, the advertising agency behind campaigns for Compare the Market, and Cadbury's. The company recently launched its own dedicated AI agency called Faith. Good to see you this morning. You think AI is going to create jobs, not destroy them? Slightly.
Absolutely. I think new technologies are often greeted by prophecies of doom about mass job losses, but history shows they're often overstated. And I think that's because it's easier to imagine existing jobs that may be lost rather than jobs that haven't yet been created yet. So if you take VCCP, our company, we 2/3 of our employees are in jobs now that did not exist when we launched in 2002. And we've been through 3 technical revolutions, if you like: the internet, smartphones, and social media. And every time these new technologies have created jobs, we've needed digital marketeers, we've needed app developers, content creators, and social influencers. And we don't see AI being any different. It's going to create new industries and new opportunities that we haven't yet thought of.
So how are you using generative AI at the moment?
Well, generative AI is the most incredible tool, and it really allows us to do things we couldn't do 2-3 months ago. So just through a very simple text instruction that's called a prompt, we can instantly create text, video, 3D models, images, and they are absolutely incredible. They will allow us to do things creatively we just couldn't do before. And I think it will have a similar effect on our industry, say to what special effects software did for film or what GarageBand did for the music industry.
That's fascinating. I mean, you've set up this business called Faith right now. What is the thinking behind having a separate division dedicated to this?
Well, I think the first is a statement of intent. There's so many negative headlines around AI, and we just reject the notion that it is bad for our industry. And we have faith that AI will be a real accelerator of human creativity. We don't think it's going to replace humans. So it is a statement of intent, but it's also an accelerator. We want a dedicated team that are isolated from today's conventions and isolated from our existing business priorities so they can fully focus on this opportunity.
I'm quite intrigued by that, though, because, I mean, a lot of the tech companies with which I've spoken lately, they've got AI as part of their core business. They're not sort of siloing it off, if you like. They're trying to integrate it into everything they do. You're taking a different approach.
Well, we're doing both. And we've already integrated a lot of AI technologies into everything we do at VCCP. But the reason we are also creating Faith is just to make sure that we are at the absolute bleeding edge of the opportunities out there.
What do you think the situation is going to be like in other parts of the creative industry?
Well, I do think it's about a mindset. Fundamentally, what is your attitude? And our attitude is it's unlikely to replace human creativity. AI, at the end of the day, is a tool. It still needs a human to control it. That human needs to set the inputs, set the parameters, and also, at the end of the day, it needs to make a judgment. A person needs to make a judgment. Is that creative and is that original? And the analogy I use a lot, we all have smartphones in our pockets that can shoot movie-grade video, but that doesn't make us all Steven Spielberg.
It doesn't. It did put a lot of traditional camera makers in jeopardy, though.
But it also introduced a whole new set of filmmakers to the industry. And the great thing about this technology, it's going to be a real democratizer of creativity as well. The cost of entry is really cheap. Anyone can download these apps, and they're quite useful, user-friendly as well. So in the grand scheme of things, I believe this is going to be a fantastic opportunity for the creative industry.
Well, we love to have a bit of optimism on this programme. Michael, good to see you this morning. Thank you.
Cheers. Thanks for having me.
Now, cybersecurity is a subject that we have covered on this programme on many occasions in recent months. Among the problems facing businesses are an increase in document fraud and the issue of deepfakes, which can put pressure on companies to prove their authenticity. Well, joining me now from Massachusetts is Matthew Moynihan. He's Chief Executive of the document authentication company OneSpan. Matthew, welcome to you. Thanks for joining me at such an unsociable hour. What are you seeing right now in terms of document fraud?
It's quite scary. I take a little bit of the opposite perspective than the previous guest. Certainly the power of AI is undeniable on the creativity standpoint, but as he mentioned, it has democratized and brought to the masses an ability to create deep fakes and really challenge the legitimacy and authenticity of things on the internet. And I think we all know that the foundation of modern business really is the fact that two parties are engaging with each other and having a legally binding contract that stands up in a court of law or before a regulatory body. And so for as good as AI is on the creativity part, it is unleashing to the masses a capability to really attack the authenticity and legitimacy of business transactions. And so I think this is a game changer in the other direction. And businesses are going to have to think about this as being the next generation of cybersecurity, which is not confidentiality and availability. We've almost solved those things. How do you prove the legitimacy of the transactions with you and your customers, employees, or partners?
Now, a big chunk of your customer base is in banking and financial services. Is that a sector that appears more at risk, in your opinion, to these kind of deep fakes?
You know, it's really anything. When we think about the customer behavior, I think we've all become accustomed to clicking on things in this one-click checkout, or clicking through a end-user license agreement with Amazon or Google or Facebook. You know, that type of behavior crosses all parts of the consumer population. In the past, you know, those of us who are more sophisticated, technically sophisticated, it's a little bit harder to trick us. But with AI and deep fakes, it's almost easy to trick anybody, right? So I think the consequences for banking, financial services, insurance, potentially are more significant given the high value nature of those transactions. I think it applies to any industry that's engaging digitally in any type of product. And people really need to think about now the type of transaction that's taking place, the value of that transaction, and appropriately map the security requirements around that journey.
The motivation of some of the people you're coming up against may also differ, I guess. I mean, traditionally, with a lot of cybersecurity, it's all about raising money and trying to sort of commit financial crimes. With deepfakes and AI-inspired cybersecurity breaches, quite often it's just sheer malevolence, isn't it? Attempting to destroy a company's reputation.
You know, for sure. And I think what you're seeing now is, you know, disinformation has been around forever. You know, back in the old days, it was the province of nation states who might take a car and light it on fire, stick some fake papers in a glove compartment and push it into a lake, right? I mean, we've all seen these types of James Bond-like movies. Now disinformation is becoming so real, it's almost indiscernible to the average person around, you know, whether a person online or whether a document is the authentic one. And so with that comes a great power for the ability to use that disinformation for fraud, account takeover, or really just influence. And when you think about the history of cybersecurity, it really has been around the ability to impersonate a person or a situation to take advantage of it. So typically it's for financial gain, but increasingly, as we've seen in politics, particularly in the US, it's around influence. And so I think the stakes are going up for sure for businesses as they continue to go drive more and more of their business online.
Matthew, obviously a lot of businesses are having to watch their spending right now. What are you seeing in terms of client renewals just now? Is this an area where some clients may be tempted to try and save a bit of money by scrimping on some of these security measures?
You know, I think it's everybody is tightening their belts around the world for sure. And I think what you've seen is in particular cases, you know, top 10 projects be whittled down to top 7 or top 5, you know, based on the economic environment. So that's certainly happening across both security and you know, the e-signature side of things. You know, that said, the online environment is incredibly robust, and we haven't seen the type of pullback in security given the financial implications of dialing back security. So, you know, again, I think the online banking industry, we're fortunate to have you know, a significant portion of our install base there, and we'll continue to monitor it very carefully. Certainly, the banking crisis that took place in the U.S. and then rippled through other international markets is something we have to watch very carefully.
Matthew, it's been great talking to you this morning. We do appreciate you getting up so early to speak to us. I'll let you go off and have some breakfast now. Thank you.
Thank you very much, and thank you, everyone. Bye-bye.
Just going to break into the business news again now. We're going to cross live to the COVID inquiry in central London, where the former First Minister of Scotland, Nicola Sturgeon's giving evidence.
Produced in 2011, you were Cabinet Secretary for Health until the 19th of May 2011.
I was Cabinet Secretary for Health into late 2012.
Yes.
That would have been me in that case.
Yes. You were Cabinet Secretary for Health until the 19th of May 2011, and then you became Cabinet Secretary for Health, Wellbeing and City Strategy thereafter.
Thank you for reminding me.
Page 5 of the report refers at the bottom of the page to planning assumptions. Respondents recognised the limitations of modelling. However, it was felt that it would have been helpful to have updated the planning assumptions more quickly to reflect the picture on the ground, in effect reflecting the most likely scenario rather than the worst case scenario. Respondents felt it would have been helpful for the process of testing the planning assumptions to be more explicit. the planning assumptions which were published did not hold much weight with responders on the grounds that they did not reflect what they were experiencing. Ms. Sturgeon, these references to the planning assumptions and to national and local responders' views as to how efficient or how useful that they were, was that a reference to the broad governmental system by which risks are assessed, grouped together, and assumptions made for the purposes of planning as to how those risks should be addressed?
So my reading of these paragraphs, and forgive me, I would need to see these paragraphs in the context of the whole paper to be certain that what I'm about to say is correct. But certainly in relation to the second bullet point there, what that seems to me to reflect is something that was certainly true in the handling of the H1N1 pandemic, is that the pandemic did not unfold in the way that the plans and the modelling and the reasonable worst-case scenario estimates had indicated that it would. And that had relevance, I think, to what we learned about the strengths and weaknesses of pre-pandemic planning. So my reading of that is that that was a statement about the gap that opened up during the swine flu pandemic between what the plan told us would happen and what in reality happened.
That issue, the divergence between risk assessment, plan, identification of response, and the reality of a pandemic, was an issue that continued to bedevil this area of strategy planning, did it not?
Yes, it did. I think that is...
Well, there we go. That's the latest from the COVID inquiry. We'll have more on that throughout the morning here on Sky News. But before I go, just want to put you in the loop on something that's going to be happening to this programme as from next week. We're going to be changing times. At the moment, for the last 3 years, we've been going out from 10 to 11 on Monday to Friday. Before that, we were 2 half-hour shows, and we're going back to that format as from next week. You'll be able to catch the first edition of the day at 11:30, and there'll be another one at 4:30 in the afternoon, which will mean that we can bring you up to date with all the latest action on the market as it closes. So from next week, there won't be this hour-long show anymore. There will be 2 half-hour editions of Ian King Live from 11:30 in the morning and at 4:30 in the afternoon. Look forward to bringing you all the latest with those. In the meantime, do stay tuned. Coming up after this short break is Jane Secker. Thanks for joining me today. Cheerio.